America's middle class is stuck in a trap that was built over years, and then stress-tested under Trump's second term. You've got the pandemic-era home price surge on one side, and the jump in interest rates on the other, which means anyone trying to buy now has to borrow a lot more money at a much higher rate than buyers just a few years ago. Average monthly payments on a single-family home have more than doubled since before COVID, and the average age of the first-time buyer has pushed up toward 40, because people simply can't put the numbers together earlier in life anymore. The 30-year fixed-rate system, which used to be America's superpower, has turned into a set of golden handcuffs. If you locked in at 3% during the cheap money era, you're effectively trapped, because moving means giving up that rate and stepping into something closer to 6-7%. From a systems perspective, that's how you freeze an entire market. Redfin's data shows homeownership has stopped growing for the first time since 2016, with the number of homeowner households edging down and renter households jumping by more than 2.5% in a single year. Turnover is at record lows because existing owners won't move and new buyers can't get in. That's why you're seeing talk of a possible national housing emergency coming out of the Treasury, alongside hints about standardizing zoning codes and cutting some closing costs. The problem is that the structural shortage is in exactly the homes middle-income families need: entry-level and mid-range houses, where builders say land, labor, and material costs are so high that profit margins are thin unless they build luxury. When you combine a 2.8 million unit supply gap with frozen inventory and high rates, the result isn't just high prices. It's a sense that the basic middle-class promise of work hard, buy a home, build equity is slipping out of reach. Trump's answer so far has been to throw out a menu of demand-side and financial engineering ideas. There's the talk of 50-year mortgages, pitched as a way to lower monthly payments and make the market accessible. Again, mathematically, stretching a standard loan from 30 to 50 years does shave the monthly payment subsidy on a median-priced home. Analyses show it might drop a couple of $100s a month thuvity, but the cost is brutal. You can end up paying hundreds of thousands of dollars more in interest over the life of the loan and taking 2 to 3 times longer to build serious equity. UBS and other analysts warn that a shift like that is less a solution and more a way of papering over the affordability problem by turning households into long-term interest machines for the financial system. Even inside the administration, there's been backlash. Reporting has detailed how White House aides were furious that FHA Director Bill Pulte talked Trump into floating the idea publicly without fully vetting it, because it looked like bad policy and bad politics rolled into one. The second lever Trump keeps reaching for is the Federal Reserve. He's publicly promising a new Fed chair who believes in lower interest rates by a lot, after months of berating the current leadership and trying to push out individual governors when they don't go along. But here's the engineering flaw in that plan. 30-year mortgage rates don't just follow the Fed funds rate. They're anchored to 10-year Treasury yields. If investors start to believe the White House is undermining Fed independence, they price in higher long-term inflation risk and demand higher yields, which raises mortgage rates even if the Fed is being bullied into cutting short-term rates. In other words, if you attack the system's referee to force cheap money, the bond market can end up making housing more expensive anyway. Meanwhile, the affordability crisis isn't just about houses. It's groceries, gas, healthcare, childcare, and debt service, all at once. Polls show roughly 3/4 of Americans say their monthly costs are up at least $100, $700 year, and a majority now believes the economy is either in a recession or getting worse, regardless of what the official inflation rate says. The Yale Budget Lab estimates that Trump's tariff regime alone is adding around $2,300 a year in costs to the average household through it, roughly $191 a month, as import taxes ripple through prices on food, goods, and manufactured products. Even after headline inflation came off its 2022 peak above 9%, prices for key grocery categories like meat, beverages, and fresh produce have kept climbing in the 1 to 4% range, which matters when wages and benefits aren't keeping pace. It's why you see people in reporting talking about cutting out small luxuries, so frozen dinners, nicer ingredients, occasional treats, just to keep 5-person households fed. On the balance sheet side, the warning lights are blinking. Serious credit card delinquencies, balances 90 days or more past due to VD, are now at their highest since around 2011. And analysts put total card debt at roughly $1.02 trillion, up more than 70% since the early 2010s. Fed and private sector economists point out that households are leaning on plastic to cover exactly the things you'd expect in a squeeze: rent, cars, insurance, and groceries. That's what the head of an American consumer credit counseling nonprofit calls a household expenses crisis. Not people maxing out cards on vacations, but people using high-interest debt to plug holes where income no longer covers basics. When you add in rising delinquencies on auto loans and growing concern from Fed officials about signs of stress on lower-income mortgages, you get a picture of a system where the buffer zones are disappearing. Trump has tried to pivot in the face of this. After months of insisting prices were way down and there was virtually no inflation, the administration has begun rolling out targeted tariff exemptions on staple food, imports like beef, coffee, and bananas, explicitly to shave grocery bills. Scott Bessent at Treasury has talked about using tariff revenue to send $2,000 checks to low B and middle-income households, and even about carving out tariff exceptions for some construction materials if a housing emergency is declared. But again, the system response is tricky, sending out thousands of dollars in checks into an economy with constrained supply risks pushing demand up faster than production can respond, which economists warn could reignite inflation and undercut the very relief those checks are supposed to provide. On the housing side, trying to juice demand with easier credit or longer loans without rapidly expanding supply just bids up prices further, especially in the exact middle-class segments that are already short of inventory. And there's a deeper contradiction in Trump's stated housing revolution. On paper, he's promising some of the most aggressive housing reform plans in American history, including cutting regulation and overhauling zoning to make it easier to build. The February executive order on reducing red tape in housing and talk of national-level planning reforms are aimed at finally unlocking more construction in metro areas where local rules have throttled supply for decades. Experts like Redfin's chief economist say that kind of reform could work the Dushen, but on a 5 to 10-year horizon, not on the 1 to 2-year political clock. At the same time, the administration's tariffs on building materials and aggressive immigration crackdown are pushing up the cost of lumber, steel, and finished goods, while shrinking a construction labor force where roughly a third of workers are foreign-born. You can't credibly say you want millions more homes and then make both inputs V&D materials and labor, CD, more expensive and scarce. From a middle-class voter's perspective, what all of this adds up to is a kind of double duplicity. First, the promise will end inflation on day one, make America affordable again, bring back the family home. Then the lived reality: higher mortgage costs, frozen housing, grocery bills that never really fall back to earth, rising card balances, and a president appearing on television from a gilded setting, insisting everything is fine while stories circulate about luxury renovations and parties at Mar-a-Lago. That visual contrasts Subi food bank lines and jacked-up card bills on one side, palatial optics on the other 2&E, is why strategists say the ads write themselves. For 2026, you don't have to invent the narrative. You just have to put the real images side by side. The deeper systems question is whether any White House, not just this one, is willing to do the slow, unglamorous work that actually fixes the middle-class squeeze, building millions more modest homes, unwinding bad land use rules, accepting slower asset inflation, and avoiding sugary rush fixes. Extra-long mortgages or politically timed checks. The numbers coming in from Redfin, the Fed, and independent economists are clear. Homeownership growth has stalled. Renter numbers are jumping, card delinquencies are climbing, and most Americans report higher monthly costs, despite the official inflation rate drifting down. The gap between that data and the message from the Oval Office is exactly where the 2026 and 2028 campaigns are going to live. If this breakdown helped, think about how you'd answer one simple question. In your own budget, do Trump's promises match your monthly statements? Or are you seeing the same slow drip into the red that the polls and data are now capturing across the entire middle class?